Every single year, millions of Americans spend hours digging through receipts, organizing medical bills, hunting down charity donation records, all to itemize their tax deductions. And most of them are wasting their time. Here's a number I want you to remember: 91%. That is the percentage of American taxpayers who now take the standard deduction instead of itemizing. Not because they're lazy, not because they don't know better, because the math tells them to. And today, with the standard deduction sitting at $31,500 for married couples and $15,750 for single filers for the 2025 tax year, the math is more lopsided than at any point in American history. So in this video, I'm going to do three things. I'm going to explain exactly how the standard deduction works, from the ground up. I'm going to show you the specific situations where itemizing still makes sense. And I'm going to walk you through every new deduction that Congress just created, that most Americans don't even know exists yet. Stay with me. This is the most important tax video you'll watch this year. To understand why the standard deduction matters so much right now, you need to understand what changed in 2018. Before 2018, before the Tax Cuts and Jobs Act, about 30% of American households itemized their deductions. That was 1 in 3 taxpayers sitting down every year, adding up their mortgage interest, their state taxes, their charitable donations, their medical bills, trying to beat the standard deduction. Then Congress passed the Tax Cuts and Jobs Act in December 2017, and they did something dramatic. They roughly doubled the standard deduction overnight. Single filers went from about $6,350 to $12,000. Married couples went from $12,700 to $24,000. The result? Millions of Americans who used to itemize suddenly couldn't beat the new, higher standard deduction. The itemizing population collapsed from 30% down to about 9%. Now fast forward to July 4th, 2025, Independence Day ironically, when President Trump signed the One Big Beautiful Bill into law. That legislation did two critical things. First, it made the TCJA tax structure permanent. The higher standard deduction isn't going away. And second, it added an additional 5% boost to the standard deduction for 2025, on top of normal inflation adjustments. That's how we arrived at $31,500 for joint filers and $15,750 for singles in 2025. And for 2026, the return you'll file in early 2027, those numbers go even higher: $32,200 for married couples and $16,100 for single filers. This is the new reality of American taxation, and most people still haven't fully adjusted their thinking to match it. Let's make sure we're all on the same page on exactly how this works, because there's a lot of confusion. When you file your federal tax return every year, the IRS lets you reduce your taxable income by one of two methods, and you choose whichever is bigger. Method 1, the standard deduction. This is a flat dollar amount the IRS gives you. No receipts needed, no documentation. You just take it. Done. Method 2, itemized deductions. This is where you list out specific deductible expenses: mortgage interest, state and local taxes, charitable donations, medical expenses. Add them all up and use that total instead. Here's the key rule: you cannot do both. You pick the larger number, and that's what reduces your taxable income. Let me show you a real example. Say you're married, filing jointly. Your household income is $95,000. You have $8,000 in mortgage interest, $6,000 in state and local taxes, $2,000 in charitable donations. That's $16,000 in itemized deductions. But your standard deduction for 2025 is $31,500. You would take the standard deduction. Every time. No contest. Now let's change the scenario. Same couple. But now they live in a high-tax state like New York or California. They have a $700,000 mortgage, and they donate $15,000 a year to charity. Their itemized deductions might look like $28,000 in mortgage interest, $10,000 in state and local taxes, SALT cap, more on this in a minute, $15,000 in charitable donations. That's $53,000, well above the standard deduction. In that case, itemize, absolutely. But here's the truth. For the vast majority of American households, that second scenario simply doesn't apply. Let's talk about the data for a second, because it's staggering. The IRS and the Tax Policy Center report that 91% of American taxpayers now take the standard deduction. Think about what that means. 9 out of 10 Americans who file a tax return get more benefit from the flat standard deduction than they would from adding up every single deductible expense they paid all year. That's not a quirk, that's a fundamental restructuring of the American tax code. And here's the wealth gap hidden inside this data. Before 2018, itemizing was common across income levels, but the people who still itemize today are overwhelmingly high-income Americans. According to IRS data, nearly 94% of tax filers with income over $200,000 itemized before the TCJA changes. Now, even many wealthy households find the standard deduction more attractive, especially with the new higher limits on the SALT deduction, which I'm going to explain in detail in just a moment. The bottom line, if you're a middle-income American, household income under $200,000, there is a very high probability that the standard deduction is your best option. And if your CPA is still spending an hour every April asking you about your receipts and your donations, it's worth asking, are we actually beating the standard deduction, or are we just going through the motions? Now, I want to be completely clear about something. The standard deduction is not right for everyone. There are specific situations where itemizing makes clear financial sense. Let me walk you through each one. Situation 1. Large mortgage in a high-cost city. If you bought a home in the last 3 to 5 years in a market like San Francisco, New York, Boston, Seattle, or Miami, you may be paying $30,000 to $50,000 or more per year in mortgage interest alone. That interest is fully deductible on Schedule A. If your interest alone clears the standard deduction threshold, you're almost certainly an itemizer. Situation 2. High state and local taxes. The SALT story. This is a big one that just changed dramatically. From 2018 through 2024, the SALT deduction, your deduction for state income taxes and property taxes, was capped at $10,000. That cap wiped out the itemizing advantage for millions of people in high-tax states. But the one big beautiful bill just changed that. For 2025, the SALT cap jumps to $40,000 for both single filers and joint filers. That is a game changer for residents of California, New York, New Jersey, Illinois, and Massachusetts, states where property taxes alone can exceed $20,000 a year. If your state and local tax burden is significant, run the numbers now. The math may have just flipped in your favor. Situation 3. Large charitable giving. If you donate meaningfully to charity, and by meaningfully, I mean more than $10,000 to $15,000 per year, your charitable deduction combined with other expenses may push you over the standard deduction threshold. High-income donors and people with donor-advised funds should specifically run this comparison every year. Situation 4. Significant medical expenses. If you or a family member had a major medical event, a surgery, a hospitalization, a chronic illness requiring expensive treatment, your out-of-pocket costs may be deductible. The threshold. You can deduct medical expenses that exceed 7.5% of your adjusted gross income. So if your AGI is $80,000, only medical costs above $6,000 are deductible. That's a high bar. But if you hit it, it counts. Here is where this video gets really valuable, because the one big beautiful bill didn't just raise the standard deduction. It created a series of brand new deductions that apply whether you itemize or take the standard deduction. Read that again. These new deductions stack on top of whatever deduction method you choose. Let me walk through each one. New deduction number 1, the $6,000 senior bonus deduction. If you are 65 or older, this one is for you. The new law created a separate additional deduction of $6,000 for taxpayers who are 65 and older. This is on top of your standard deduction. On top of the extra senior standard deduction you already qualify for. On top of everything. The income limits. It phases out above $75,000 for single filers and above $150,000 for married couples filing jointly. It's available for tax years 2025 through 2028. Let me put real numbers on this. An older couple, both 65 or older, filing jointly, income under $150,000. Standard deduction, $31,500. Extra senior deduction, 2 spouses times $1,600 each, $3,200. New bonus senior deduction, $6,000. Total, $40,700 in tax-free income. That is extraordinary. That is the highest effective standard deduction in American history for this group. New deduction number 2, the tip income deduction. If you work in a tipped profession, restaurant servers, bartenders, barbers, cosmetologists, delivery drivers, you may now be able to deduct your qualified tip income from federal taxes. The deduction phases out above $150,000 for single filers and $300,000 for joint filers. If you earn most of your income from tips and fall under those income limits, this could mean thousands of dollars back. Talk to your tax professional about qualifying your tip income. New deduction number 3, the overtime pay deduction. If you receive overtime pay, and millions of American workers do, the portion of your paycheck that represents overtime may now be deductible up to $12,500 per year for single filers, and $25,000 for joint filers. Same phase out, above $150,000 single, $300,000 joint. For a household with one spouse working significant overtime, this is a real, meaningful deduction that didn't exist before July 2025. New deduction number 4, car loan interest. Normally, personal loan interest is not tax deductible. Mortgage interest, yes. Car loans, historically, no. The new law changes that. You can now deduct up to $10,000 in interest paid on a car loan for a new qualified passenger vehicle. This applies whether you itemize or take the standard deduction. If you bought a new car recently with financing, check with your tax preparer on whether you qualify. Section 6, the age 65 plus picture, the biggest winner. Warm, direct, many viewers in this category. I want to spend an extra moment on retirees and near retirees because the 2025 and 2026 tax changes are genuinely historic for this group. Let's build the full picture for a retired couple, both 65 or older, filing jointly with income under $150,000. For 2025, standard deduction base, $31,500. Additional deduction for each spouse being 65 plus, $1,600 times 2 equals $3,200. New bonus senior deduction, $6,000. Total deduction, $40,700. That means the first $40,700 of your taxable income is completely shielded from federal tax. Compare that to just 8 years ago, before 2018, when the standard deduction for a couple was just $12,700. The protection for seniors has more than tripled in under a decade. And here's one more layer. If your Social Security income falls below the IRS taxable threshold, and a meaningful portion of retirees are in this situation, you may owe very little to no federal income tax at all. The combination of the standard deduction, the senior bonus deduction, and Social Security tax exclusion rules has created a scenario where millions of retirees are paying effectively zero federal income tax on a combined income of $40,000 to $60,000. If you're in or near retirement and you've never run these numbers, get in front of a CPA or a tax professional before December 31st. Year-end tax planning in this environment can be genuinely life-changing. SALT stands for state and local taxes. It includes state income taxes, state sales taxes, and property taxes. From 2018 to 2024, the SALT deduction was hard-capped at $10,000. For residents of states like California, New York, and New Jersey, where state income tax rates alone can hit 9 to 13%, this cap essentially destroyed the benefit of itemizing for many families. A family in New Jersey paying $18,000 in property taxes alone couldn't deduct more than $10,000 of it, under the old cap. The One Big Beautiful Bill changed that cap to $40,000 for 2025. It increases 1% per year through 2029, and then, critically, it drops back to $10,000 in 2030 unless Congress acts again. What does this mean practically? If you live in a high-tax state and you have a significant mortgage, you should absolutely run an itemized deduction calculation for 2025. The math may have just shifted decisively in your favor, especially if your combined SALT burden is above $20,000, because at that level, combined with mortgage interest and charitable giving, you may be well above the $31,500 standard deduction threshold. Okay, let's bring this all together with a simple 3-step test. You can do this right now, tonight, in about 10 minutes. Step 1. Add up your potential itemized deductions. Write down your mortgage interest from your Form 1098, your state and local taxes paid, capped at $40,000 for 2025, your total charitable donations with receipts, any qualifying medical expenses above 7.5% of your AGI, Add those four numbers together. Step 2. Compare to your standard deduction. Single filer, $15,750 for 2025. Married filing jointly, $31,500 for 2025. Head of household, $23,625 for 2025. If your itemized total beats these numbers, itemize. If it doesn't, standard deduction wins. Step 3. Apply any new above-the-line deductions. Regardless of which method you choose, ask, are you 65 or older? Add the $6,000 senior bonus deduction. Did you receive overtime? Calculate up to $12,500 in overtime deduction. Do you receive tips? Ask about the tip income deduction. Did you finance a new car? Check the $10,000 car loan interest deduction. These stack. They don't go away based on your deduction choice. And if math isn't your thing, every major tax software program in 2026 will run both calculations automatically and show you which one wins. TurboTax, H&R Block, Free Tax USA, they all do it. You enter your information, and the software picks the better path for you. There is no excuse in 2026 for leaving money on the table. Here's the honest truth about American taxes in 2026. The system has never been simpler for the majority of households. The standard deduction is higher than it has ever been. New above-the-line deductions are available to millions of workers and retirees. And the IRS has essentially said to 91% of Americans, here's your flat deduction, take it and go home. But, and this is critical, simpler for most does not mean better for everyone. If you have a large mortgage, live in a high-tax state, give significantly to charity, or had major medical expenses this year, do the math. Every single year. Because the SALT cap change in 2025 may have just moved you from the standard deduction column back into the itemizing column. Tax law rewards people who pay attention, and you're clearly one of those people, because you're still here. Drop a comment below. Do you take the standard deduction or do you itemize? I read every single comment, and if this breakdown saved you time or money, share it with someone who needs to see it. I'll see you in the next one.